Good morning. We are today going to do two very interesting problem on uh, stock prices only. And what we are going to do is that how short selling can be used as a strategy for hedging against volatility in the stock prices. Okay, so we have already done short selling two problems. Those who have not watched them, I request you watch that video first and then come to this. So the problem statement is, suppose you bought 100 shares at rupees 25 and it's now 10 months you bought them and the price has risen to 75. That means the price is appreciated by 50 rupees. And now it has become 75. So 50 times 100, 5,000 is your unrealized gain. You still don't want to sell it, right? Why so? There could be many reasons. Maybe because it's a short-term transaction, less than 1 year, you want to save upon tax. Maybe you think that share price, say, after say few months may go up sharply, but in the near term, you are little suspicious that the price may decline. So you are in a dilemma whether to sell them off at 75 or hold them, because price may decline also. So now short selling comes as a hedging strategy. How? Let us see. So let us look at this table first. 75 is the price at the moment. And if you are going to make first a short selling, so suppose you do a short selling of 100 shares, okay, and then thereafter, because your unrealized gain is 5,000, you want to protect this 5,000 rupees, right? So what do, you short sell 100 shares at price 75, which will fetch you 7,500 bucks. Suppose after some time price becomes 65. Then what you need to do, you have to cover your whatever you had shorted, and when you cover that at price of 65, you gain 1,000 rupees. So those shares, those 100 shares, now you can do long transaction. That is, since you have covered them up, you can now sell them in the open market again, and that will give you 4,000 bucks, right? So your total sum in your pocket will still be 5,000, which is same as 5,000 if you had sold them at the price of 75. Let me repeat it. Let me again make this clear with another example where, say, price becomes 45. Now you have sold 100 shares. You have shorted 100 shares at the price of 75. So that means you borrowed from somebody 100 shares at 7,500. You sold them off at 75, and you sold them off in the market, and you pocketed say 7,500. Now since the price has fallen to 45, and you'll still have to return those shares to somebody. So what will you do? You will have to buy shares worth 45. So still 75 minus 45 into 100, 3,000 rupees will be in your pocket. Now you still hold your own shares, not those short sold and covered shares, but those shares are priced at 45 now. So if you say sell them at 45, because the initial price was 25, you are still getting 20 bucks per share, which gives you 2,000 rupees as a long transaction. So long transaction 2,000, short transaction 3,000, total 5,000. If still you could not understand the problem, let us see what happens if the share price falls at 25. If the share price falls at 25, you bought those shares at 25, so you get nothing, right? So if you sell those shares, you square off. You don't, no profit, no loss, right? But since you have shorted 100 shares at a price of 75, and now it is Now it is 25. So what will happen? You can cover that short and get 75 minus 25, that is 50 rupees per share, multiplied by 100, and your 5,000 are still protected, right? So 5,000 remain protected in each case. So this is a hedging strategy by short selling. So what do we mean here is that you sell short at 75, then as price declines, close the deal and gain, right? This is something we call short sale against the box. I repeat, short sale against the box. Okay. So it's a technique of combining transactions so as to try to achieve a position of reduced risk, right? Now, there's a drawback. We saw that the concern was that the price may go down, but after we sold at 75, suppose price instead of going down goes up to 100. You start gaining on your long transaction, but you start losing on your short transaction. So your 5,000 remains protected, but you will have to forego the additional gain you would have got if you have not done this hedging strategy, right? Another example we try to see about rights issue, but we'll take this up in the next video.